All right, let's talk about something that honestly catches so many people off guard. Taxes in retirement. It's a whole different ballgame with a completely new set of rules. And you know what? Understanding them is absolutely key. So let's just jump right in with a big question. A lot of us kind of dream about retirement as that finish line where we can finally stop worrying about taxes. It's a super common thought, but is it actually reality? Well, the truth is, tax season can be a massive shock for new retirees. The assumption that your tax bill just magically shrinks or disappears once you stop working, it's probably one of the most common and most costly misconceptions out there. So today, we are going to break it all down. First, we'll get into your income streams. Then, we'll talk smart withdrawal strategies. After that, we'll cover some really costly mistakes you want to avoid. Look at proactive tax planning. And finally, we'll tie it all together for your financial bottom line. Sound good? Let's do this. First up, and this is like the absolute foundation of smart retirement tax planning, you've got to know your income streams. And the crucial thing to get is that the IRS does not see all your retirement money in the same way, not even close. And that brings us to this key term, tax treatment. It sounds kind of formal, but all it really means is the rule book the government uses for each type of money you get. Is it taxed like regular income? Is it tax-free? It all comes down to the source. Now check this out. This table really shows the different tax buckets you're working with. Think of your traditional IRAs, 401ks, and pensions. That's your tax later bucket. You pay income tax when you pull the money out. Then you've got your Roth accounts, the tax-free bucket. Amazing, right? Withdrawals are usually tax-free. And then there's Social Security, which is kind of in its own weird bucket. The point is, you can't just look at the grand total, you have to know which bucket you're dipping into. So, knowing how your money is taxed naturally leads us to our next section, smart withdrawal strategies, because it's not just what you have, it's how and when you decide to take it out. And this is a perfect illustration of a classic trap. Let's say you need a big chunk of cash, maybe for a new car or a big trip. If you pull it all out of your traditional IRA at once, you could accidentally shove yourself into a much higher tax bracket for the year. The smarter move? If you can, spread that withdrawal across 2 tax years. That could help keep your income and your tax bill way more manageable. Okay, now for a section that could literally save you a ton of money and a major headache. We're talking about costly mistakes, because in the tax world, little slip-ups can have some pretty big financial consequences. And the number one absolute cannot forget rule is about something called required minimum distributions, or RMDs. Basically, once you hit a certain age, Uncle Sam says you have to start taking money out of most of your retirement accounts, whether you need it or not. And they are not messing around with this rule. So what do you think happens if you forget, or maybe you just don't take out the full amount you're supposed to? 25%. And no, that is not a typo. The penalty is a quarter of the amount you are supposed to withdraw. Ouch! As our source material puts it, that's an expensive mistake for forgetting a mandatory distribution. And they're right. It is one deadline you absolutely do not want to miss. And here's another costly mistake, and this one's rooted in a really common myth, that your Social Security checks are always tax-free. The reality is, it's a little more complicated. It all depends on what the IRS calls your combined income. That's basically your other income, plus some non-taxable interest, plus half of your Social Security benefits. If that number goes over a certain line, wham, a chunk of your benefits becomes taxable. So how do you avoid all these nasty surprises and penalties? Well, this brings us to proactive tax planning. This is all about playing offense, getting ahead of the game instead of just reacting to a big tax bill in April. And you've got some really powerful tools in your toolkit here. We're talking about things like Roth conversions and a really slick one for charitable folks called Qualified Charitable Distributions, or QCDs. Not to mention just managing your withholding and making estimated payments. Okay, let's break down that QCD strategy, because it's pretty awesome. If you're 70 and a half or older, you can donate up to $100,000 a year straight from your IRA to a charity you care about. Now here's the genius part. That donation can count as your RMD for the year, but because the money never actually hits your bank account, it doesn't count as taxable income. It's a total win-win. And one final proactive tip, and this is a big mental shift from your working years. You don't have an employer automatically taking taxes out of your paycheck anymore. That job is now 100% yours. That means you have to actively manage it, either by asking for withholding from your distributions or by paying your taxes in quarterly chunks. Okay, let's bring it all home. How do all of these pieces, the income streams, the strategies, the mistakes to avoid, how do they all fit together to protect your financial bottom line? You know, when you boil it all down, tax planning in retirement is really about one simple but powerful idea. It's about understanding where your income is coming from and then being super strategic about how and when you take it out. That's it. So let's just do a quick recap of the essentials. 1. Know the tax rules for each of your income buckets. 2. Try to spread out big withdrawals. 3. Whatever you do, never miss an RMD. 4. Plan for the fact that your Social Security might be taxable. And 5, hey, this stuff is complicated. Don't be afraid to get some professional help. And that kind of leaves us with one final thought for you to chew on. As you look at your own situation, is your retirement plan just a savings plan, or is it truly built to be a tax minimization plan? Because honestly, the difference could mean thousands and thousands of dollars over your retirement. Hey, if you found this explainer helpful, please think about sharing it with someone else who's planning for or maybe already in retirement. Thanks so much for tuning in.